Hello and welcome to the latest MPS update. My name is Jerry Lawler and I'm a Business Development Director at Rathbones. I'm joined today by Andrea Young, our MPS Investment Director, and also by David Coombs and Will McIntosh-White, our fund managers of the building block funds that we use within our MPS. Today, we're going to focus on the four pillars that underpin our managed portfolio service, those being the investment philosophy, our unique investment solution, the efficiency, and also value and service. David, why don't you kick us off first on our investment philosophy?
Yeah, I guess the first thing we thought about when we were redesigning the service was putting the client front and center, focusing on the outcome, focusing on what their needs are. Because clearly, quite often, a client investing in MPS is a big share of their wealth. And so we need to think of it holistically. And what we do, which is slightly unique compared to many others, is, of course, we look at the risk and return framework, as you would expect. But we also had a third element, which is the time horizon. And the time horizon is a pretty critical factor in your risk profile, if you think about it, because clients that require some funding in the next 2, 3, 4 years, or maybe they're slightly older and may have some funding they weren't even anticipating, then that's a really important factor that should go into any investment process. So we've linked the three together to come up with our approach of focusing on liquidity. The second point I would say is that we try to minimize any compromises when it comes to investing to ensure that the portfolio, looking through the three building block funds that make up the service, are as diversified as possible, having access to the widest possible investment universe and allowing us to trade on a daily basis. That's really important to try and ensure that we are in control of the performance and that we are not at the mercy of any idiosyncratic clunkiness in the process itself. Also, focusing on costs. We are investing directly in every single investment. That means we have ownership of those investments. They are our conviction. We know exactly where the risk is placed. And that also has the advantage of stripping out a layer of costs, which many MPSs have when they invest in third-party funds. So we know exactly where the portfolio is invested. We're stripping out costs. And that ensures that, in our view, we have control over the outcome itself.
Brilliant. Thank you, David. And Andrea, if I can come to you, can you talk to me about the efficiencies of our MPS?
So the features of this proposition has really been centred around seeking out the value for clients and making it as efficient as possible. So when we're thinking about this building block structure, what this has allowed us to do is actually broaden our investment universe. We know that platforms, it can be quite restrictive to what is available. So by using the building blocks, we've expanded that investment universe to help support returns. Also, from an efficiency perspective, we've been able to reduce that time out the market. We know with platform rebalancing that sales and purchases can't take place on the same day. So by being able to do a lot of the trading underneath that building block structure, it reduces that time out the market. And when we do need to rebalance, that's a lower percentage that is being rebalanced. And also, from a risk management point of view, we're able to manage risk effectively because we know exactly what is under the bonnet. Unlike multi-manager single strategy funds, it can be difficult to look at the exposures of risk at any given time.
And just to add, there's no automatic rebalancing with this proposition, like others, which I know some advisors get quite frustrated by, particularly when it's near the tax year end. And you will only be rebalancing the models when it's absolutely necessary, which will probably be due to a significant market event, because most of the time, the asset allocation and bottom-up stock decisions will be taken within the building block funds themselves.
Thanks, David. Thank you, Andrea. Will, turning to you, let's look at our unique investment solution. Can you give us more detail on our asset allocation risk framework?
Yeah, so the MPS is constructed using 3 building block funds. And they are based on our proprietary risk framework, which is where we categorize assets essentially according to how we expect them to behave. So we look at their liquidity, we look at their correlation to risk assets and categorize them into either liquidity, equity type risk, or diversifying assets. So there are 3 funds. The Global Fixed Income Fund, that will be where the liquidity assets are, so they're highly liquid assets. We expect them probably to have a slightly negative correlation to equities in times of market dislocation. Typically, we'll be investing in government bonds here, so US Treasuries, UK gilts, Australian government bonds, but also highly rated corporate bonds and cash. And this is a fund where you'd expect to have higher weights in your low risk strategies. We also have the equity type risk fund. So that is clearly invested in equities and anything else we might expect to be highly correlated with equities, particularly in times of market stress. And those are the assets that we expect to really drive the growth of the portfolio. And so you might also expect to find in there lower rated corporate bonds, high yield bonds, private equity, infrastructure, or emerging market debt. And again, with those funds, you'd expect to have a higher weighting in that fund in the higher risk strategies. And then lastly, diversifiers. Those are assets which we're really expecting to help reduce or offset the risk in periods of stress. We expect those investments to have low correlations, which will really provide genuine diversification to the overall strategies. Within that fund, you might expect to find traditional diversifiers like gold or agricultural commodities, but also slightly different investments that we'll have like structured products, where we're looking to either hedge certain risks or to find genuinely uncorrelated return streams.
And finally, the 4th pillar, value and service. Andrea, can you talk about cost and how clients will be able to see the assets they're actually invested in?
So in terms of cost, we're going to have a 0 DFM fee. We're going to have an OCF cost cap of 50 basis points. So essentially, when you're looking at the wider market, this is actually very competitively priced for a fully active solution. And in terms of look-through reporting, we know that with advisors, transparency and a look-through approach is very important. So because we have full oversight of every single holding underneath the bonnet, we'll be able to report on that. So advisors know exactly what they're investing in, and we'll be able to explain all the underlying changes.
And Jerry, can I just add, I mean, it was noticeable when we were building the design for this new service that many of our competitors have started increasing the amount of passive investing in their active models, really trying to compete with the passive MPSs that have been taking market share. And we will not be doing that. This proposition will be fully active for that 50 basis point cap. And the other point also worth mentioning, I think, is that the fee within the fund is accrued on a daily basis, which is even fairer for the client rather than those 4 kind of dates during the year. So hopefully we're showing that every item within or every part of the service has been designed with enhancing performance in mind.
David, Andrea, Will, thank you very much. That was very informative. For more information about our new managed portfolio service, please contact your local business development contact or follow the screen for more information. Thank you.